record. Okay, so learning objective 2 introduces you to financial ratios. And like I was telling you before, financial ratios are used to measure the company's health in terms of its profitability, in terms of its liquidity, and in terms of its solvency. So those are the 3 areas we're going to be looking at, okay? But a ratio is simply, you know, a comparison, a relationship between 2 numbers. And, you know, this has been known for years. It's even in Shakespeare's, you know, ratio, wherefore art thou ratio? Maybe I misunderstood. Maybe I'm blowing it out of proportion. Only a fraction of you would get that, but anyway. Okay, enough math jokes. I'll keep moving on. So here is a look at some of the ratios. Profitability ratios are, you know, is the company making more profits over time? And we usually rely very heavily on something called earnings per share. And we look at that ratio over time to see if the company has been a good investment for the owners. Because over time, you want your company to have more profits, and you want your share of those profits to increase over time. And that usually gives your ownership stake more value, which is a nice way of saying your stock price should be going up as the company becomes more profitable. And so profitability ratios, there's one in particular that we're going to be looking at here, get introduced to. Liquidity ratios, as the word liquidity means, are they able to grab cash? I mean, you need cash to pay your bills. There's no other way to pay your bills other than cash. So think about all the regular bills that companies have. They have to pay their rent, they have to pay their employees' wages. You know, they have lots of different things to pay. They have to pay for supplies that they might owe. Do they have the cash, or do they have access to the cash to pay that? And so liquidity ratios look at that company's short-term ability to pay its debts with cash. Mm-hmm. And the last form of ratios is about solvency. And solvency basically is looking at the company's long-term debt, okay? And that's important because, you know, some companies have taken on way too much long-term debt and they are unable to survive, okay? That's what's happening to a lot of retailers right now. They just have way too much debt, and they don't have enough revenue coming in to help pay all their bills, so they have liquidity problems, and to pay their long-term debts, so they have solvency problems. And so those are some of the introductory ratios that we're going to be looking at. So in order to figure out the profitability ratios, you have to look at the income statement, because only the income statement tells you of the profits of the company over time, okay? Now, this is an odd one because they've chosen Best Buy. I don't know why, but they've chosen Best Buy to look at here. This is the income statement numbers for their accounting years for 2013 and for 2014 that are listed here. But it's interesting because in 2013, as you see, Best Buy had a loss. So in this case, a net loss, because their revenue, which is the number here, was smaller than their expenses, or the expenses were bigger than the revenue. Once that happens, you get a loss. But as you see in 2014, their numbers, their revenue increased quite nicely. Their expenses stayed, well, they did increase, but not as much. And lo and behold, in 2014, they returned to profitability. These numbers are all in millions, and so it looks just like $532, which is nothing to write home about. But it's actually $532 million, which is something you probably would want to write home. And so if you were a stockholder in Best Buy, you probably are going to be one of millions of other shareholders. So if Best Buy did make $532 million profit, how much of that profit, those earnings, if it was broken up by the number of shares of the company, how much of those profits are mine per share? Now that's really what earnings per share looks at. It'll take a look at the profit of the company and divide it by the number of shares of ownership. And that gives us what we call earnings per share. Earnings per share. Remember, earnings is the same as profit, yes? Per share, well, remember, corporations are broken into shares of ownership. So you have to buy one share at a time. Now, whether you own 1 share or 10 shares or 100 shares, you're still a stockholder, you're still a shareholder. The question is, if I have 100 shares versus 10 shares, and the company made $532 million, how do we distinguish and keep things equal? Right? Well, earnings per share breaks down the amount of profit into the number of shares. And so each share can calculate the portion of the profit that would be literally allocated to them at some point. So the number of shares fluctuate through every year. And that's because some companies issue more shares through the year, so the number of shares increase. Some companies buy back their shares, and so there'll be less. There'll be a decrease in shares. So what we do is we take an average of their shares for a given year to figure out. So if you want to look at 2014, the numbers down here, you'll see that Best Buy had $532 million of net income. Now, there are companies that actually had preferred stock, which we're not going to really look into until chapter 11. Preferred stock basically gets paid a dividend first, and they don't have any voting rights like common shares would have voting rights. The problem with this formula is that only about 6 to 7% of companies today have preferred stock. And so that means that if only 6 or 7% of companies have preferred stock, then this will be figured out. That means for the other 93% of the time, it's going to be 0 because there's no preferred stock, there's no preferred dividends. So it's simply the profit of the company divided by the average number of common shares, which is the average between the beginning and end of the year will give you an average. These two numbers added together divided by 2 will give you an average. So if you take the $532 million and you divide it by the average shares, each share of ownership would have made a profit of $1.55 from this year's earnings. So whether you have 10 shares or 100 shares, each share earned $1.55. Now, this is important over time because what we want to look at is over time, every quarter, and certainly every year, has the earnings per share been increasing over time? Some companies are wonderful with that. McDonald's, once McDonald's started franchising and then became a corporation and then sold shares of stock. So from the mid 60s to the mid 90s, for a 30-year period of time, every single quarter, McDonald's would report higher earnings per share. Okay, and because it was really about the founder of the McDonald's franchisor, which is his name is Ray Kroc. They used to say, you know, the earnings per share every quarter would be higher, just like clockwork. So instead of like clockwork, they'd say clockwork. So they would, you know, almost like telling time. You could always bet that when McDonald's reported its earnings per share every quarter, they'd be higher than the previous quarter. And you could see that over time. Microsoft was the same way for a long period of time. There are companies that struggle to have earnings per share. Tesla has not had a track record of consistent earnings per share. They do have profits some quarters, they have losses every quarter. But what's really important as an investor, as a stockholder, is you want your business to be profitable over time, continuously. So Apple has been that way. A few other companies have been that way, that continuously speaking, they do better over time. And they tend to have better stock performance because, as a matter of fact, if you ever watch any of the shows on the business channels, they talk about earnings per share all the time. You know, and that's oftentimes reflected in the value of the stock price. In 2013, they didn't make any money. They actually had a loss. So that loss, you know, is also divided by the number of shares. And so each share of ownership in 2013 actually would have needed to cover $1.30 of the loss for the company. Okay. Losses, by the way, are covered by retained earnings first. If there's no retained earnings in the company, stockholders have to basically pony up the equity to cover the loss. There's a review question here. Stoneland Corporation had a profit of $26,000. They had net sales of 400. That's nice. We don't really need to know that. They have outstanding shares of 6,000, and of course, this is a textbook. They have $2,000 preferred dividends. So what would the earnings per share be? Earnings per share. Well, what you would see is you would take the net income of 26,000, subtract out the preferred dividends of 2,000, and divide it by the amount of shares, which is 6,000, which means the answer here would be $4 per share. So the profit of the company after the preferred stock dividends was 24,000. There are 6,000 shares of ownership. So each share of ownership would technically get $4 of the profit. Okay. Of course, as you know, this is not what they actually do. They actually share a portion of the profit in the form of a dividend because owners are not stupid. They want most of that money to be put back in the company, retained in the company, to make them more profitable in the future. For the liquidity ratios and the solvency ratios, we need the balance sheet. We need the balance sheet. The liquidity ratios are going to be looking at our access to cash. And so they tend to focus on the total current assets, which are often used to pay the current liabilities. So we'll often see current assets compared to current liabilities for liquidity ratios. Once we get to solvency, we're going to be looking at the long term. Okay, so again, liquidity, the ability to turn assets into cash to pay your obligations within the next year. So this is mostly about current. There are two ratios that your book introduces you to. The first is something called working capital. And working capital is simply the difference. It's just a subtraction. You take your total current assets, subtract out your total current liabilities, The remaining portion is something that we call working capital. Okay. So Best Buy's example here, let's go back to Best Buy for 2014. So the column that's represented here, they had current assets of 10,485. They had current liabilities of 7,436. So the difference between these two is what they call working capital. And so Best Buy had a working capital of 3,049. Now those numbers are in millions, and so even though it might look like a small amount of money, this is actually $3 billion. The most common of the ratios that you'll see for liquidity is something called a current ratio. It's very, very popular ratio that's being used. And as you see here by the formula, you're simply comparing current assets to current liabilities. It's just a comparison of the totals. So you have total current assets on the top, total current liabilities on the bottom, and the difference is provided. So here, let's look at Best Buy for 2014. So you'll learn what this means. Best Buy, as you know, had current assets of 10,485. That came right from the balance sheet. Let's go back, make sure you know. That came right from here, right? 10,485. Notice the current liabilities here, 7,436. That's what you see. That's what you see here. So when you compare these two numbers, it comes out to a ratio of 1.41 to 1. What does that mean? It simply means that Best Buy has $1.41 of current assets for every $1 in current liabilities. That's how we would read it. That's all it really means. We're simply comparing the amount of total current assets to the amount of total current liabilities. And we're breaking it down in a ratio form so it looks like a part of a dollar. Okay. That is better than 2013 numbers. When you looked at 2013 numbers for Best Buy, they had current assets of only $1.11 of current assets to cover every dollar of current liabilities. So obviously, the more current assets there are to cover the liabilities is good. So back in my day, we were looking at basically a 2-to-1 ratio as something that was very strong. Today, that might be just having too much cash. And so we're looking at basically anything close to 2-to-1 is good. It's very, very good. H.H. Gregg, you might not have heard of H.H. Gregg, but they are basically a big retailer of electronics like Best Buy. They are, I've seen one down as I travel down south. My parents are in South Carolina, so I'll travel down south. I've seen them in Maryland and things like that. So as I've traveled down south, that's where I've seen them. But it's basically, you walk in, you think you're in a Best Buy, but it's an H.H. Gregg. It's a competitor of Best Buy. As you see, their current ratio is very strong. They have $1.68 of current assets to cover every dollar of current liabilities. So they're in a very, very good, what we call liquidity position, because they have plenty of current assets that they can liquidate to pay their bills, their current bills if needed to right away. The industry is in a different space. The industry means all of these electronic retailers. Okay. So Best Buy and H.H. Gregg are electronics retailers. The industry as a whole, these are all electronics retailers. It's a real competitive environment today, mostly because profit margins are being diminished. You know, there's so much inventory involved. There's so much change in the industry that it's hard for them to manage it all and be profitable. And you can see that from the industry average current rate. Their current ratios are pretty bad. They have 88 cents of current assets to cover every dollar in current liabilities. So if everything was due today, they'd be in trouble, most of them. H.H. Gregg is in good shape by those numbers. Best Buy is in good shape by those numbers. The industry as a whole is in a very weak shape in terms of liquidity. Solvency is about long-term debt. Will the company be able to pay interest? And will the company be able to pay its debt due when it matures? So it's looking at long periods of time, but it's looking really at long-term debt and the company to the company's ability to pay long-term debt. The one ratio that's used all the time that you'll see as we go through the book, and this introduces you to the debt to asset ratio. Remember, how does one buy their assets? Well, the only way you get assets is one of two ways. One of three ways. You either put the money in, you have the money yourself, and you buy the asset. So that would come from equity. Or you would borrow the money to buy the asset. That would be a liability. So this particular ratio looks at the amount of total liabilities compared to the total assets that you have. So it's actually a very simple ratio that you would get from the balance sheet, right? Because the balance sheet would have the total liabilities listed and the total assets listed. So you're simply looking at those two numbers. So Best Buy, as you look at 2014 numbers, has 10,024 of total liabilities, 14,013 as total assets. That comes to a debt to asset ratio of 72%. So basically, 72% of their assets are financed with debt. Okay, that's basically what this is. Now that's better than their 2013 numbers. 78% of their assets were financed by debt. They've lowered that to 72%. That's good. That's good, right? H.H. Gregg, their competitor, obviously does not have that type of stress, right? Because their debt to asset ratio tells us that 51% of the assets were financed with debt, which means they have a very high equity stake, right? Because the only way a balance sheet works is you have total assets on one side, total liabilities and stockholders' equity on the other side. So if it wasn't, if 51% of their assets are financed by debt, the other 49% of the assets are stockholders' equity, because it's the only thing it can be on a balance sheet, right? Balance sheet equation, very important. Total assets are on one side, total liabilities and stockholders' equity on the other side. It's the only three things that belong on the balance sheet, right? So if 51% of their assets are financed by debt, the other 49% of their assets is financed by equity. So they're in a very strong position in terms of solvency compared to Best Buy, although Best Buy is not that bad. The industry is in tough shape, right? 88% of their assets are financed by debt. That's an enormous amount of debt for a retailer. This is one of the problems that happened with Toys R Us, Sears. They just had too much debt and they couldn't pay it back. Okay. And so what happens when you become insolvent, right? These are solvency ratios. Well, if you can't pay anything back, you become insolvent. And so that's basically how you need to see the terms. Solvency means you're able to manage and pay back your debt long term. If you're insolvent, you're unable to do that, which means most cases you're out of business. Okay. So the industry is under a lot of stress because 88% of their assets are financed by debt. And that's a lot of debt to have on the books if you're a retailer. This wouldn't bother me so much if it were General Motors or a large manufacturer, because oftentimes large manufacturers use a lot of robotics and other equipment. And equipment is commonly financed by debt. You usually buy equipment with loans. Equipment loans are very common. So you would have a higher debt to asset ratio in certain manufacturing facilities because of the assets that they have to buy to run their business. But in a retail store, they shouldn't have that much debt. So the solvency is an issue here. Sometimes, not all debt is bad. Debt financing, again, when you want to get money, you've got two choices. Either you put the money in or you borrow the money. You want to buy a car, you got those choices. You can put some money down, you can borrow the rest. That's financing. Chapter 1, learning objective 2, financing activity. Some companies have very low debt to asset ratios. Well, Google, they don't really need a lot of, this is mostly intangible asset driven type of stuff. They need a lot of workers. They need some equipment. Not going to need a lot of debt. Like I said, manufacturers like GM that listed down here, most of the way they're building their cars and trucks, SUVs is on a assembly line that's basically robots. It's overwhelmingly robotic. And that's equipment. Gotta buy equipment, modernize a plant, in a building. So almost all of this is probably plant and equipment debt, and that can pay off over time. So yes, it's high, but it's not terrible because of what they do. Okay. There is another ratio that's listed here that's based on the cash flow statement, something called free cash flow. We're not going to cover that in this particular class. We will review this when we get to the cash flow statement in managerial accounting. Okay, so here you have do it exercise number 2 in your book, ratio analysis examples. Look at all of these wonderful categories. Okay, remember that's where you have those ratios. So the first thing they want you to do, compute earnings per share. Earnings per share is the net income minus preferred dividends divided by the average, weighted average common shareholders. And so here you have the solution provided for you for Frost Company for 2017. This is how you calculate earnings per share. For 2016, this is how you calculate earnings per share using the numbers that you saw here. Here's the net income numbers that you're going to need. Oh, why are these 2016, 27? I think this is just a typo here. In your book, it should be fine. So there's the preferred dividend. So you need net income, subtract out preferred dividends, and you're going to divide that by the average shares to those two numbers averaged out. Okay. Current ratio, debt to asset ratio. Current ratio, as you know, is simply current assets compared to current liabilities. Here's your numbers listed here. Debt to asset ratio, total liabilities compared to total assets. We don't have to worry about free cash flow. All right, so I'm going to stop right there, bring us back to our main screen, and see if there are any questions.